An earnings report provides key financial data and performance metrics about a publicly traded company, giving investors insights into how well the company performed over a specific period, usually a quarter or a year. The earnings report includes several critical sections, each offering valuable information about the company's financial health, profitability, and future outlook. Here's a breakdown of the main components. 1. Earnings per share, or EPS, the net profit of the company divided by the number of outstanding shares. Why it matters. EPS is a key measure of profitability on a per-share basis and is closely watched by investors. It's typically compared to analysts' estimates to determine if the company beat, met, or missed expectations. 2. Revenue, also known as sales, the total amount of money the company made from selling its goods or services during the reporting period, reported as gross revenue, which is the total income from sales before any costs or expenses are subtracted, and net revenue, which is revenue after any returns, allowances, or discounts. Why it matters. Revenue is a fundamental indicator of a company's overall growth and market demand for its products or services. Analysts compare it to market expectations. 3. Net income, or profit, the total profit of the company after all expenses, taxes, and interest have been deducted from revenue. Why it matters. Net income is an indicator of how efficiently a company is managing its operations and costs relative to its sales. It's one of the key figures that affect EPS and stock price. Gross profit and gross margin. Gross profit is calculated as revenue, minus the cost of goods sold, also known as COGS. This includes the direct costs of producing goods or services. Gross margin, on the other hand, is gross profit expressed as a percentage of revenue. It shows the percentage of revenue that exceeds the costs of production. Why does this matter? Well, gross margin indicates how efficiently the company is producing its products or services, and it helps investors assess operational efficiency. Operating income, also known as operating profit, is the profit a company makes from its core business operations. This figure excludes non-operational income or expenses like taxes or interest payments. Why is this important? Operating income focuses on the company's core activities, showing how well the business is managed without considering financing or external factors. Operating expenses are the costs associated with running the company's day-to-day operations. This includes salaries, rent, marketing, and research and development, often referred to as R&D. Why does this matter? High operating expenses can reduce profitability. Investors look at this figure to assess how efficiently the company controls its costs. EBITDA, or earnings before interest, taxes, depreciation, and amortization, is a measure of a company's overall financial performance. It focuses on profitability before the impact of financing decisions, taxes, and accounting methods for depreciation and amortization. EBITDA is used to compare profitability between companies, as it removes factors like interest rates and tax regimes that vary by company or region. Cash flow is another key metric. Cash flow from operations refers to cash generated from the company's core business activities. Cash flow from investing activities involves cash used in or generated by the company's investments, such as purchasing equipment or acquiring businesses. And cash flow from financing activities includes cash received or paid out as a result of issuing or repaying debt, paying dividends, or issuing stock. Cash flow is crucial for assessing a company's liquidity or its ability to cover short-term liabilities and invest in future growth. The balance sheet is a fundamental financial statement. It includes assets, which are what the company owns, such as cash, inventory, and property, liabilities, which are what the company owes, including debts and obligations, and shareholder equity, which is the net value belonging to shareholders after liabilities are subtracted from assets. The balance sheet gives a snapshot of the company's financial position at the end of the reporting period, showing its ability to meet financial obligations and invest in growth. Guidance or outlook is essentially the company's projections for future revenue, earnings, or other financial metrics, typically for the next quarter or fiscal year. This is crucial because guidance helps investors gauge what management expects for the future. Positive or negative guidance often has a significant impact on the stock price after the earnings report. Dividends, if applicable, refer to the portion of earnings the company plans to distribute to shareholders. This is quite significant for income investors. Changes in dividend policy, such as increases, cuts, or suspensions, can influence investor sentiment and stock prices. Comparable sales, also known as same-store sales, measure the sales growth of a company's existing stores, excluding new locations or closures. This metric is particularly important for retailers and restaurants, as it shows how well existing operations are performing without the effect of expansion. Debt levels, the total amount of debt the company holds, including long-term and short-term debt. High debt levels can be a concern, particularly in rising interest rate environments, as they affect the company's financial flexibility and cost of capital. Non-GAAP metrics. Many companies report non-GAAP, or generally accepted accounting principles, measures like adjusted earnings per share, adjusted EBITDA, or adjusted net income. These exclude one-time charges or extraordinary items, giving a clearer view of the company's normalized performance. Non-GAAP metrics are useful for analyzing recurring profitability, though investors should be aware that they can sometimes obscure certain risks. Other key metrics and ratios. Profit margins. Operating or net profit margin shows the percentage of revenue that turns into profit. Return on equity, or ROE, measures profitability in relation to shareholders' equity. The price-to-earnings ratio, or PE ratio, is used to value the stock based on its current earnings. An earnings report provides detailed financial data, including earnings per share, revenue, net income, cash flow, and guidance. Investors use this information to assess the company's performance, comparing it to market expectations and making buy, sell, or hold decisions based on the results. Options traders focus on the volatility generated around earnings announcements, using strategies like straddles or iron condors to capitalize on price swings. It is difficult to say whether it's more common for a stock to rise or fall after an earnings report, as it depends on a variety of factors, including market expectations, the company's performance, and the broader economic environment. However, here are a few general trends that can help understand stock price movements after earnings. 1. Meeting or beating expectations. When a company meets or exceeds market expectations in its earnings report, in terms of revenue, earnings per share, and future guidance, the stock price is more likely to rise. However, the magnitude of the rise depends on how much of a surprise the earnings report is to investors. If the market has already priced in strong results, even a good report may not lead to a significant price increase. In some cases, even beating expectations might lead to a stock decline if the forward guidance is weak or the market expected even better results. 2. Missing expectations. When a company misses analysts' estimates or gives weak forward guidance, the stock price tends to drop. This is because investors adjust their future expectations of growth and profitability, often leading to a sell-off. 3. Volatility. Stocks often experience increased volatility around earnings releases, meaning prices can swing significantly either way. Even if a company reports strong earnings, the stock may still drop if the market had much higher expectations. This is known as priced to perfection. 4. Long-term trends. Historically, stock price movements after earnings reports are relatively balanced between going up or down. Some studies suggest that stocks more often decline after earnings reports, particularly if the company's results or forward guidance disappoint investors. However, over time, companies that consistently beat earnings expectations tend to see long-term stock price appreciation. Factors influencing post-earnings: stock movement, market expectations, and sentiment. If the market has been overly optimistic, even good earnings can result in a sell-off. Forward guidance. Sometimes strong earnings are overshadowed by weak future outlooks, leading to a drop. Sector performance. A company's stock might rise or fall based on broader sector performance trends, regardless of earnings. Macro conditions. Broader economic conditions, like interest rates and inflation, can also influence post-earnings moves. In conclusion, it's fairly balanced whether a stock goes up or down after earnings, but stocks tend to drop more frequently after earnings misses, or if expectations are not exceeded. Options traders approach earnings season differently than stock traders because options provide flexibility to profit from various scenarios, including price volatility itself. Here are some common strategies. Pre-earnings strategies. Implied volatility increase. Implied volatility often rises before earnings announcements, reflecting the market's expectation of a big move. Traders may capitalize on this by selling options, calls, or puts to benefit from the higher premiums before volatility crashes after the report. Earnings reports have a major impact on stock prices, with outcomes driven by whether a company meets, beats, or misses market expectations. Options traders employ various strategies during earnings season, focusing on volatility, potential price swings, and market sentiment.